Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Tyler Chesser. Tyler is a distinguished real estate visionary renowned for his pivotal role as the co-founder of CF Capital, a private equity real estate investment firm with a strategic focus on partnering with institutional and high net worth individuals. Tyler spearheads transformative ventures in the acquisitions and operations of large multifamily communities across the Midwest and the Southeast U.S. Tyler amplifies his impact through business coaching, keynote speaking, and has served 5 years as the host of Elevate podcast, which is ranked among the top 200 in business podcasts worldwide. So, Tyler, I'm looking forward to this. Welcome to the show.
Keith, thank you so much for having me, my friend. It's great to be here with you and look forward to serving your listeners.
Absolutely. And if we could, maybe I like to start with really your story, where you grew up and what eventually led you to real estate as a profession.
Grew up here in actually Louisville, Kentucky, as you and I were kind of catching up and getting to know each other before the podcast. I guess my family, well, I grew up in Louisville. My family is, I'm descendants of farmers, really, more than anything, which is kind of interesting. I don't really know my full ascendancy history, but, grew up in Louisville. Actually, as I was growing up as a child, I was always fascinated with marketing and branding, and that's what I actually went to college for. And I ultimately pivoted into real estate a few years after I started my corporate career. I was actually doing international marketing for a large restaurant company. But I ultimately made a transition, pretty drastic turn in my career to move into real estate. I really wanted to take more control over my future. And ultimately, I kind of dipped my toe and then dove into the deep end of real estate. And, throughout those years, I've kind of made a transition, from corporate employee, sort of marketing specialist type of individual to, now sort of an owner operator of large multifamily. But it's been quite the journey, but, really the roots started way back when, and, the growth continues today.
Yeah, that's interesting. It's not unusual, I guess, for somebody to be starting kind of in corporate America in some form or fashion, and then kind of finding their way to real estate. When you say you dipped your toe in and then got right in the deep end, what type of real estate did you start in, and kind of how were you exposed to that?
So I dipped my toe in because when I was actually a corporate employee, and I got my real estate license, and I started doing some sales on the side. So it truly was dipping my toe in. It was like nights and weekends, still doing the 9 to 5, but I was dipping my toe in because, it was really not my main gig until it really started to take off. It took off after really less than a year of getting that license and starting to do some sales. I actually started with residential sales. And I quickly learned that wasn't really where I wanted to continue my future, but I learned a lot in terms of just how the transactions worked, just some of the nuances there and some of the particulars surrounding real estate law and so forth. But there was a lot of emotions involved when it came to representing those clients. While it was a great launching point at the time. It was something that I quickly realized I didn't want to build a career in. But that was kind of the dipping of the toe. But as I grew as an agent, I learned so much about all the different avenues and landscapes within real estate. And of course, income producing real estate really caught my attention. And the recognition of the outcomes that you can create in your life as a result of investing in income producing real estate was very intriguing to me. So actually, as I dipped my toe in, it was kind of by happenstance and just by executing and learning and growing that I got referred to others who were investing in, larger income producing commercial real estate. And I actually was referred to a larger group, really an investment company that had a portfolio of assets that they were looking to dispose of because they were looking to ascend to their next sort of rung on the ladder, so to speak, in terms of their objectives. And they were looking for a young hustler, a young agent to go out there and sell a lot of assets, some of which were, somewhat challenging and others that were not so challenging, but they needed somebody who, could really roll their sleeves up and work hard. But it gave me the opportunity to really dive into the deep end as an agent. And over the course of a couple of years, I was able to sell off that portfolio for them and really build a strong book of business through that experience that was really all about referrals and just networking and growing my exposure and really utilizing my marketing background to expose my business to a larger set of clientele. But throughout that time as well, I really gained perspective of what it means to be an investor as well by advising investors and really understanding sort of how that market works. And, my timing was pretty fortuitous. I actually got into the business in 2013 and, coming out of the great financial crisis, there was quite a run up there. And, prices were still relatively attractive, especially in comparison to, where things have grown to, up to COVID and now, late 2024. So, during that time, it was interesting because I was able to grow and transact because, the market was, at that point, it was definitely expanding. But it definitely heated up as I continued to grow. But I started investing. The first deal I ever invested in was 8-unit apartment complex, small multifamily deal. But I learned a lot, made a lot of mistakes, and just continued to grow. And sort of the next deal I did was 32 units, and started investing passively in other much larger deals. And so, growing to today, it's just kind of been like each stage has been like a stepping stone. But I ultimately transitioned away from the brokerage world about 5 years ago. I ultimately, learned a lot, did very well financially, but really wanted to develop a different type of lifestyle. I mean, that lifestyle, even as a commercial real estate broker, which I ultimately built my own brokerage company after a few years of being an agent and being kind of an apprentice, so to speak, under some others. I ultimately built my own commercial real estate brokerage company, but that lifestyle was, highly in demand. I remember, I was almost like suffering from some of the success that I had built where I was in just constant demand. I was, there was deals being negotiated just 24/7, it felt like. And even while, the demands of a commercial real estate broker are certainly different than a residential broker or agent. You're not necessarily showing properties on nights and weekends, but those deals and the timelines, they just really never stop. And I remember it was actually Christmas Day. There was a deal that was, it was kind of on the rocks, and all the parties were wanting to still have discussions on Christmas Day. And I was like, this is it. I'm not doing this anymore. So it took a few years from that stage to really, put pieces in place to where I could make that transition. Fortunately, I'd built, kind of a medium-sized personal portfolio of assets that were generating cash flow, but I made the decision that I wanted to transition to being a full-time principal and real estate investor rather than, principal on the brokerage side. So that was kind of the high level of my journey.
Yeah, I think that's an important part to kind of highlight and just, maybe talk a little bit more about is just, obviously working. Now, when you were working on Christmas Day, do you have any kids or
I do
does that
now. I
look
did
like?
not at the
Okay.
time, but if
Okay.
I
But
did
either
at the
way, it was
time, it would have
Christmas.
been even more
Right.
unacceptable. But I was having a little bit of a selfish, unacceptable feeling at the time. But yeah, now with kids, I mean, that would have been a total no.
Yeah, for sure. But the flexibility of starting to build a portfolio and have that cash flow coming in kind of gave you some options, which I think a lot of times people don't necessarily, it's not that they maybe don't recognize, it's just, it is a nice thing to be able to have. It gives you a little bit of an option. So at that point, when you had the ability to maybe step away and say, brokerage has been great, it's been lucrative, but it's just, there's no, the day doesn't end, it's just constant. What were you having come in from a passive income standpoint, which allowed you the flexibility to be able to say, you know what, moving from here, I can, start to be a principal only on some
Yeah, I
of these
think
deals?
I would describe myself at that point as being financially independent, not necessarily financially free, but I was
Okay.
kind of betting on myself to kind of take that next leap into that real financial freedom. So in other words, I would say that if I were to reflect back to that time, it's probably been about 8 years or so. My passive income, quote unquote, because I was an active like all of the real estate assets that I owned, with the exception of a couple passive deals, was all active investing. And so I described that income as passive, yet it was still to a large degree fairly
Understand.
active. My that income that was being generated from those assets was largely covering my lifestyle expenditures. And I wasn't married at the time, didn't have kids or anything like that. So I was kind of making a bet on myself. And
Mhm.
as I learned more about the components of multifamily real estate, which is where I've really focused my efforts since day one, while I was transacting several different asset classes from a brokerage perspective, I really focused my time and effort and energy on apartments. And what I learned about apartments was the name of the game is scale. And I actually learned that from some of my early passive investments, my limited partnership investments, because as I studied those monthly financials and annual financials, I recognized just the economies of scale and sort of the percentage of the costs for certain components such as insurance and taxes and utilities and so forth, and having the ability of putting a professional team, quote unquote, on the field for larger scale investments was just so much more beneficial. And to really go where I wanted to go, I knew that I needed to invest in larger assets, and learning about the opportunities of compiling other investor capital, whether that be from accredited investors, even sophisticated investors and or institutional capital, was sort of a realm that I had to sort of wrap my mind around. But fortunately, being financially independent to a point where then I could start to make bigger bets on building a business around a larger scale type of investment operation was really the direction that I wanted to go. And so that's the direction that I did choose to go. Ultimately, in 2019 was when my business partner and I really started to have more in-depth conversations about putting together this company and the company now, CF Capital. We've been around for almost 5 years now. We had fortuitous timing in forming right before the global pandemic came together.
Right.
And so when that happened, we're thinking, wow, this is, the next 2009, we're just going to get all these deals on total sale. And ultimately looking back, obviously, hindsight is, 2020 for lack of a better description. And certainly those discounts didn't necessarily come to bear, but interesting timing nonetheless.
Yeah, for sure. And so had y'all been exposed, you said you'd mentioned something about possibly being involved in some limited partnerships along the way, in addition to the joint ventures and things that you were doing. So did you had some exposure to some syndications, and was that through the original folks that you were working with that were unloading their portfolio, or was that just somewhere else along the way that you kind of learned about that?
So I actually learned about that world from some of my clients because they were pooling capital, they were syndicating deals, and I didn't really know a lot about the concept until I was exposed to it from just transacting some of those deals. And as I learned about that, I just started to really network in those worlds, go to the conferences and meet the folks who are putting those deals together to really learn about, how it works and, whether or not that was a direction that I wanted to take my own sort of professional career and obviously investing career. And as I did that, I met others who were putting together deals in other markets and just started to kind of understand how that worked and what the return profile was, what the tax benefits of that was. And, I'm a big believer in, if you want to learn something as an investor or if you want to learn something financially, you should put your dollars to work in it. And obviously something that you can be comfortable with losing and, recognize that, you probably have a certain degree of incompetence, whether that's conscious or unconscious. But for example, somebody asked me the other day if I'd put any money in cryptocurrency, and I have. And the reason why is because I wanted to understand it, rather than read a book on it or listen to a podcast, which I think are great things to do. I think it's sometimes, especially as an investor, more helpful to a certain degree to put your money to work. That's how I learned early on actively investing, by making so many mistakes. And I think you can make much less mistakes as a passive investor, especially if you invest with the right people. But it was really all about networking and really just kind of following my curiosity. And as I kind of opened my lens up into this world of passive investing or private placement, partnerships, I started to learn more about who is doing what, who is doing things the right way, and what markets were worth investing in, what markets were, looking to avoid. And, it just kind of cascaded from there.
Okay. And as far as the first official deal with CF Capital that you did, what did that first deal look like, where you raised capital for?
First deal we did was 247 units in a market called Evansville, Indiana. So it's the second largest city in Indiana. Not a huge city. I think 500,000 population there, but 247 units. It was actually about a $9.5 million acquisition. And so this was a property that was completely classic. None of the units had been renovated. It was built in late 70s. So you can imagine sort of the interior of those units as you walk in. But we saw it as, completely a value add, like classic value add type of opportunity where we could go in and invest a couple $1 million worth of renovation capital for interior and exterior projects. There were some exterior deferred maintenance projects that needed to be attended to. And, that was our first deal with CF Capital. And we are actually still actively invested in that deal. We're coming up on our 4-year anniversary kind of mid next year on that deal. And things are going really well. Property's cash flowing and performing. And so, but yeah, it was good to finally get that first deal under our belt about 4 years ago. But, we early on, especially when interest rates kind of went to zero, it was very difficult to understand sort of pricing and, where things were really going to shake out. Because you have, on one side, you've got, the supply chain problems that we had kind of in early 2020. You had all the sort of uncertainty of the pandemic. But then you had the other side where, capital was essentially free. So there was a lot of irrational exuberance going on. So not super easy to place capital at the time, but we've been pretty patient yet persistent in continuing to grow our portfolio.
Okay. Well, that's a huge first deal for sure. And it sounds like everything has everything. I guess that'd be a question for you. Has everything gone as planned, or were there surprises on that particular one?
I think that, anytime that we're looking at a pro forma or like even a construction budget, we should always recognize that this is an initial kind of hypothesis and that you're always going to receive feedback. So I think for the most part, things are on track or, things that we would have expected, but there's certainly been twists and turns along the way. And I think one of the most important things as an operator, as an investor, as somebody who's, taking control of your own financial future, you should always be prepared and ready to adapt and pivot and receive feedback from the market. for that particular deal, our costs of renovations have been a little bit higher than we would have anticipated, and that we did anticipate, but also our renovation premiums have exceeded expectations as well. So essentially, all in, if you kind of shake the blender up, our return on investment has been more positive than initially anticipated. Some of the stabilization of a turnaround of a complete renovation or really a repositioning of an asset like that sometimes takes a little bit longer than you would like to see it take. And so, I think some takeaways would be to, be a little bit more conservative in the timelines, but also perhaps a little bit even more conservative in terms of costs and, timelines of, renovations and so forth. So those are some of the high level things that have not necessarily gone exactly the way that we anticipated, but that's something that as we move forward, there's always going to be unexpecteds in any investment.
Yeah, no, that makes sense. And I mean, timing wise, some of the increased cost in building materials that we experienced during COVID due to supply chain and different things, that would be hard for anybody to estimate or kind of build into their plan, in advance. So kudos to you all for being able to work your way through that, but also be able to it sounds like on the other side of it with the premiums on the renovated units. You worked your way through it and it became a positive thing on the other side.
Yeah.
So.
And I think sometimes it's better, to a certain degree, like, there's going to be good luck. There's going to be bad luck. There's going to be things that you cannot anticipate. Like, for example, the supply chain scenario is something that nobody could have, been able to foresee. But, I remember, so on this deal, the way that we financed that deal was we actually acquired it with a bridge note because it was a significant repositioning. So it wasn't a stabilized asset. It really, we acquired it from an owner who was self-managing from Portland, Oregon. So, you can imagine the low-hanging fruit from an operational perspective, but it wasn't a deal that was like you just acquire it and you set it and forget it and you walk away and you come back in a few years and it's just chugging along. It needed a lot of attention, but the way that we financed it was through a bridge note, and our lender said, look, you can buy a rate cap if you want. You don't have to. We decided to buy a rate cap for the full term on that. And we're very fortunate that we did, because at that time, interest rates were near zero. And throughout the hold period, the Fed has obviously, increased rates historically in nature. And so we're very fortunate. And, sometimes I say it's better to be lucky than good. We decided to do that. And the rate cap was very inexpensive for the time because there was no real expectation of inflation coming through the way that it did. But I think, as you can continue to play the game, I think the more reps that you have, the more likelihood that you have of being lucky and making good decisions like that. So, we wouldn't have known how good of a decision that was at the time. But, hindsight now, looking back with that experience, we can use that moving forward and anticipate whatever market conditions can come. And I think being more conservative is always more helpful than not.
Okay. Yeah. And what, on that one, how big of a raise was it? And did you have the investors just through maybe, I'm sure coming from being a commercial broker, that helps. You've got some folks already out there, but what are some things that you've done also to kind of just build your investor base?
Yeah, that was about a $3 million raise. And, it was not a super heavy lift, but it was my first equity raise on my end. And it was really, most of our investors on that deal were either friends and family members or people that I had transacted with in the past, other investors in real estate, people that I had built relationships with in the local market or in the regional market, but actually even across really the country, and people that, it's like, I think what I learned for a few years and kind of growing my business was that it is kind of a small community. While, the regions can be large, most of the people who are active players, you start to kind of learn those people and you start to build relationships with them. But, those people that invested with us on that first deal were people that, They just believed in us. They believed in the project. And we had, fortunately, my partner and my business partner was also a broker in his previous life as well. And so we had both built a lot of relationships in the space. I think another lesson learned in raising capital is that sometimes it's much more challenging to convince somebody that real estate is a great move. And by the way, I'm going to convince you to invest in my deal with me. So the people that were actually investors with us in that deal were people who already believed in real estate. They were already actively investing in real estate. They also believed in our market, and we had a relationship with them. So these were, relationships that had been built, over years. And it wasn't really people that had found us on the internet or anything like that. But over the years, we've certainly continued to expand our brand, our reputation, and our capacity to build trust with other people, whether they're other limited partners or institutional investors. We now have, we actually have a programmatic institutional equity partner now that we're continuing to expand. We actually just closed a deal with them literally this week on Wednesday. But ultimately it really is kind of a long-term relationship game as well from an equity standpoint, equity raising, whether that's individual retail investors, limited partners, or institutions. And a lot of our investors today that we've built relationships with have come through referrals of existing investors as well. So, it's continuing to invest in our marketing and expanding our reach so that we can build more trust, more confidence with the marketplace. But to a large degree, it's about repeat investors. It's about people who have come through other introductions from people that have invested with us in the past.
Okay. And after this initial first one that you've done, at first, where was that geographically, and then where are you currently invested in, and kind of give me an idea as to, I guess, kind of what you guys are looking for at CF Capital as far as a potential buy for you.
So our markets, we're kind of regionally focused: Kentucky, Indiana, Tennessee, and Ohio. We just closed on a deal in Indianapolis. We really like that market. It's a really strong market. What we would describe it, most of our markets outside of Nashville, Tennessee are kind of slow and steady, chug along, long-term growth oriented markets. They're not going to be, really your boom or bust markets, but, we really invest in the large MSAs within those 4 states, in particular, Indianapolis, Columbus, Cincinnati, Louisville, Lexington, and Nashville. And that first deal was in Evansville, Indiana. We still like Evansville. It is, it's got some dynamics that are such that we're not necessarily looking to expand our footprint there today. Just the growth characteristics and job growth does not necessarily meet sort of our metrics as we move forward. But anyway, the focus that we have is really, it's, we're very close to our markets. We're actively invested in our home market, our backyard here today, and we're very hands-on in terms of our deals. And I think that is a separator for us. We buy deals directly from owners, people that we know, and obviously marketed deals as well. But I think our partners who are really all over the globe. In fact, we have partners in Australia, we have partners in Canada, we have partners in probably nearly every state in America. And I think our partners like to have exposure to this region because it's kind of counter-cyclical to some other markets that may be experiencing, boom or bust type of components. While it's great when you're in the boom scenario, it can be obviously very challenging from a bust scenario. So our markets are not nearly as sexy as some others, but I think that allocating capital towards multifamily real estate is also not nearly as sexy as some other vehicles. But ultimately, it is about downside protection. It's about cash flow. It's about tax benefits. And we like kind of how our markets mesh with those characteristics as well. I hope I answered your question, but I'm not sure if I completely did, Keith.
No, I think you pretty well did. And so maybe from an investor standpoint, And I think I think there's something to be said about not necessarily going after necessarily the sexy markets. Like you said, when they're good, and they have a tendency to swing a little bit more when they're not, or things slow down a little bit. So, with from an investor standpoint, when you're looking at the deal, what does like the capital stack kind of look like? As far as how much loan are you putting to the value? And then from a hold period standpoint, anything else that you can give us from, what you would if you were talking to an investor and saying, hey, here's kind of what we are after in these deals. Here's our business plan. And I recognize that it will change a little bit from, asset to asset, but in general, what is it that you focus on?
So the capital markets are a big determining factor here. The state of the capital markets is a big determining factor. And like where we are today at the end of 2024, there's quite a bit of volatility in the capital markets. While, we had a rate cut from the Fed, nearly 2 months ago, our first rate cut in this new cycle. We did just have another about a week ago. While that has occurred, most of sort of the debt financing in our market is really based on the treasuries and the bond market. And the bond market over the past couple months, even 45 days to be more specific, has been on quite a run. And so, interest rates are actually going up in our world. And as a result of that, sort of the access to capital in those dynamics are changing and have changed. But to a large degree, I just say that just to kind of set the stage to say, the capital market is always changing based on many dynamic factors across the world, whether it's geopolitical, fiscal policy related, from a macroeconomic standpoint, or even domestic policy standpoint. So, generally our capital stack is obviously dependent on that. But in today's market, we're generally looking at, lighter value add projects that are stabilized, that we can acquire with agency financing. And generally agency financing, just to be even more particular, Fannie Mae, Freddie Mac, are really kind of the gorillas in the room, or the great equalizers in our space. And generally we're looking to, obviously leverage can be a very powerful tool to amplify your returns, but it can also be something to contend with that you've got to be careful with. And so we want to kind of toe that line to where we want to amplify our investments as much as possible, but we also want to be properly leveraged to a point where we're protecting downside. And generally speaking, our investments are anywhere from 60 to 70% loan to value. And generally, we will capitalize any renovation dollars via equity as well. And so when we're acquiring a deal, we're going to put down, call it 30%, 30 to 35% equity. And then we're also going to raise an additional tranche for renovations and other fees associated with the investment. So that's typically how it works. And in terms of the time frame, every deal is unique in terms of the business plan. Every deal we have to look at in a unique fashion. Like, for example, the deal that we just acquired, we actually assumed a Freddie Mac loan that had 4 years remaining. So on that deal, it is a 4-year time horizon. But generally speaking, one of the variables that we keep constant when we're acquiring or analyzing or underwriting a new deal is that we're looking at a 5-year time horizon just to compare apples to apples. And generally that gives us enough time to implement a business plan, add value to the asset, reposition, whether it's interior or exterior or both, renovations or operational repositioning. It also gives us the opportunity of seeing through kind of a phase of the market cycle to get to the other side for an exit. But we're always open-minded in terms of an early or longer term hold if necessary. But generally in terms of, we're like, for example, on our acquisition pipeline, we're always evaluating new opportunities. But the constant that we tend to hold pretty strong is that 5-year time horizon. That generally tends to be kind of the hold period that we look at. But deals can go from anywhere from 3 years to really 10 years in terms of an overall time horizon.
Yeah, makes sense. It's kind of hard to kind of foresee that, especially right now. It just seems like right now, I mean, there's so much in the unknown, where there's a lot of assumptions and there's a lot of things that, I think will happen, but you just don't know until it plays out. So
you certainly don't. I mean, there is no crystal ball. And if you have one, or if any of your listeners have one, I'd love for you to just share that with me. But yeah, we don't know where things are and where things will continue to go. But what we do know is that, if necessary, let's just say we have a 5-year time horizon deal. We know that if in 5 years, it's not the optimal time to sell, we need to always have multiple exit strategies or multiple, contingency plans, whether that's refinance and hold longer, or, also be prepared to exit early if for some reason the market turns positively, and you're, outperforming expectations. One of my mentors said to me years ago, if you're winning in the fourth quarter, don't put more time on the clock. Being a big basketball fan and, former player back in the day, that really resonated with me. It's like, if you're winning in the fourth quarter, we don't need to go to overtime. So let's put some points on the board here.
Yeah, for sure. No, that makes a lot of sense. And so as we sit right now, the latter part of 2024, tell me a little bit about what CF Capital's portfolio looks like, and then maybe if you can paint the vision for us as well as to what you see from a goal standpoint, the next 3 to 5 years, maybe even as far out as 10 years. What are you hoping for?
Absolutely. So today we own and operate a portfolio of about $200 million in multifamily assets across our target markets. We want to keep going deeper in our markets, and we really want to establish even more of a foothold. So we're fortunate to now kind of being almost 5 years into this journey. I think have our sea legs underneath us here, and our goal is to really, for lack of a better description, like 10x where we are. Now that's going to include, obviously exits, and there's going to be assets that roll off through just sort of the natural iteration of what we were just talking about. But here over the next 10 years, I mean, our goal is to get to 15,000 units. Currently we're at about 1,500. And so it's not really meant to be more like an ego thing to say, how much do we have under management, but it is kind of our target to really grow. And, I think it's important also to keep purpose in mind. While of course we want to deliver great outsized returns with asymmetric risk, reward sort of profile to our partners, we also want to make an impact in the communities that we invest in. And our company philosophy is elevating communities together. And what that means is really doing the right thing by our residents, by our staff, and of course our partners to facilitate sort of a long-term relationship. And there's many things that go into that, but ultimately that growth is something that's important to us and something that's important to our team as well, because we want our team members to have greater future opportunities as they continue to build a long-term track record within our company and alongside our company as well. So that's really the goal, is to continue to grow. And fortunately, while we have a kind of an affordable housing crisis in this country, that's the same in really our region. And we believe very strongly in the thesis of investing in apartments, because human beings, we need 3 things. We need food, we need water, and we need shelter. And we're investing in shelter. And we're focusing on really kind of B-class assets in A or B locations within those markets, to where we can go in and we can implement a business plan to add value to that asset. So we're not really investing in like brand new Class A luxury construction. We're not also investing in C-class distressed product. While we do have experience in that, it's not really the asset class that we're focusing on as we continue to move forward. But that's really where things are today and where they're moving forward. And, I'm a big believer in, if you are going to think, you should think big, and you should challenge yourself, and you should think about figures that are going to kind of make you uncomfortable and strive to grow. One of my core tenets is that, human beings were designed to go big. And one of the things that we're big believers on here at our company at CF Capital is that, you should strive for greatness and you should strive for big things. So that's really the vision for where we're taking things.
That's great. And as far as property management goes, what does that look like? How do you utilize property management? Is it third party? Are you vertically integrated? What does that look like?
Currently, it's third party. We work with a couple different companies right now, depending on the market and the specific asset. We are at a point where we are considering vertical integration within property, bringing property management in-house. But it's not something that we've completely committed to just yet. It's a very challenging business. It's probably the hardest part of the business, just the day-to-day operations. There's always a problem to solve, and really that's how you create value in that space. But it does require great people, great systems, great processes, and it requires a certain amount of capital to really invest in to be able to create those conditions. So it's long term. I think in a perfect world, especially on paper, if you can fully align the interests of your property management to your investments, I think that's the best thing that you can possibly do. But we do work with some phenomenal third-party property management companies that, to a certain degree, it's very challenging to replicate what they do on a day-to-day basis. Right. One of the groups that we work with is one of the largest property management outfits in the country. They manage over 100,000 units. And so their capacity to solve problems on our behalf, and that's really with our asset management team. Like, for example, we have a full-time managing director of asset management. And of course, we have other team members who support that function. And that requires a lot of time, effort, energy, attention, expertise, and so forth. But those day-to-day execution through a third-party property management company like that is extremely helpful in achieving our goals. But I think long-term, in a perfect world, we will vertically integrate, but it's yet to be seen in terms of what that time frame looks like. Yeah.
Well, no, I think it's smart. I mean, if you know that you've got third party right now that does their job extremely well, I mean, it's hard to replace that. And like you said, it's a difficult deal. Sure, you can be more aligned if you're doing it in-house in some respects, but you got to have that infrastructure in place, and there's some type of a transition that happens at some point with that. So I think that's exciting.
Yeah, I mean, you've always got to be expecting the unexpected in property management. It's like, okay, my property manager has decided that he or she is, now looking to move on to greener pastures, and then you've got to be ready. Like, you've got to be ready. Your HR team has got to be ready to do a timely and effective recruitment. That's one component of the overall process. Oh, we also had, let's just say we had a problem at an asset. Maybe a resident has, committed some crime, or, maybe they've run a vehicle into a building, or maybe there's been a fire at an asset. I mean, we've had all of these things, and you have to be ready 24/7, 365 to deal with those kind of things. And, it requires a certain level of infrastructure to be able to handle that. So we've been very fortunate to work with great third-party property management companies. We've also, been less than fortunate to work with some that are less than great, and we've had to, make changes. But, it's all a journey.
Yeah, for sure. How about from, again, going kind of back to an investor standpoint, if somebody's listening to this, Tyler, and they're saying, I'd like to find out, of course, more about, CF Capital and your group, I'm going to give you an opportunity to tell everybody where they can go to find out. But from a communication standpoint, that's one of the things I've found has just been tremendous, with a lot of it's a tremendous thing that sometimes gets overlooked, and that's communication with investors. So tell us a little bit about how CF Capital communicates with their investors and keeps them abreast of what's happening with their investment.
Well, I'm glad you asked, because I think it's super important and something that we place a lot of emphasis on. Because as I mentioned, our partners are, some are local to some of the deals that we invest in, and most are not. And so we think it's important for folks to have the opportunity of viewing their investments with full transparency on an ongoing basis. So from a baseline perspective, the way that we communicate on our deals is, at minimum, on a monthly basis, we send out a comprehensive update to our investor partners via email on sort of the state of operations, the state of capital expenditures or renovations, and then also the status of really the investment, whether it relates to distributions or tax planning and tax documents and things like that. But in addition to all those factors, really the financial performance. So that's something that we've built a team around and a function around, is, really kind of the investor relations experience. And that's really the foundation of it. So it comes down to monthly communications, but also we do an annual state of the investment or kind of a state of the union type of presentation or call with our investors. And that's really a more comprehensive, presentation or webinar that we're going out and we're saying, hey, here's where things stand relative to our initial plan, because everybody made an investment decision based on the projections of the asset or the expectations. And, as we mentioned earlier, things never go exactly as planned, sometimes much more positively than planned. And sometimes you have some challenges to deal with. And so we think it's important to be transparent on all of those factors. And we are always transparent on those factors on a monthly basis, but also more broadly speaking on an annual basis. Beyond that, we have an investor portal where investors have the opportunity of really logging in at any time to be able to view performance of the asset. And while it's not like investing in a stock where you can kind of see the value of your investment on a minute by minute basis, they really do have a full viewpoint of a more inefficient asset, but they can have a viewpoint of, hey, how are things performing? And they can ask any questions, they can reach out. And, we do have relationships with really all of our partners. And we think it's important for them to be able to answer or ask any question and have the answers that they need to feel comfortable about where things stand. But we think we do a pretty good job on this, and we try to continue to up-level how we're doing that on a really ongoing basis. We're presenting information in written form, but also in chart form and in financial reporting form and so forth. So there's really a kind of a 360-degree viewpoint of how we view investor relations and communication. So it's important, but we try to treat our investors the way we want to be treated. And while we're limited partners in other deals, we've seen great things. We've seen, less than great things. And so we try to make that a great experience for our partners as well.
Yeah, sounds really good. That's great. Tyler, how can folks find out more about CF Capital if they want to invest with you, if they want to connect with you? Obviously, you've got your podcast as well. If you want to speak maybe to that, anything related to the business coaching and stuff that you do as well.
Absolutely. So folks, if they want to learn more about CF Capital, we certainly invite you to visit our website, cfcapllc.com. Again, that is cfcapllc.com. We have a lot of educational materials on our website and other things that you can access. We actually have a great ebook that really illustrates all of the different ways that we add cash flow to multifamily investments. And so folks can utilize that for their own benefit, or they can learn more about our process. We also have a comprehensive free webinar for folks as well. It's really about elevating your financial security and performance through investing in multifamily real estate. So you can access all of that on cfcapllc.com. And really, our whole philosophy is we're playing the long game with potential partners and people, and we have an abundance mindset. If you receive value from us, we're not asking for anything in return. If you feel compelled to invest with us at some point in time, or you want to learn more about future opportunities, we certainly welcome you to build a relationship with us. And I think the first step is really to go to our website and to join sort of our investor community. And of course, again, there's zero obligation to that, but we provide a lot of ongoing educational sort of resources for folks who are looking to learn more about these type of investments or learn more about our markets or all of the above. So those are a few things. You can also find me on social media across the board, on Twitter, or I guess now X, and, Instagram and so forth, at the Tyler Chesser. And, if you want to learn more about, coaching or consulting, you can visit my personal website, which is tylerchesser.com. I do work with a select group of individual investors on an ongoing sort of one-to-one basis. Something I'm really passionate about. I'm passionate about growth of human beings. I'm passionate about expansion of possibilities. Something that I've benefited a lot from throughout my years as an investor, as an entrepreneur, is business coaching and high performance coaching, and really understanding sort of the limits of, sometimes what we place on ourselves from a psychological perspective, I think is important, but also thinking about some of the mistakes and things that I've learned and I've learned from others is something that I'm passionate about continuing to pour into other people's cups. I've become super passionate about personal and professional development. I think that's really the key. That's been the key to my success over the years. But if you want to learn more about that, be happy to meet any of your listeners if they want to just visit my website, tylerchesser.com.
Awesome. All right, Tyler, this has been really great. I appreciate it. I've really enjoyed having you on the Wealth Flow. I've got two more questions that I ask every guest. One is just any advice you would give somebody who's maybe just starting out in their investment journey?
I think the best piece of advice would be to focus on personal growth. Invest in yourself. Whether you have millions of dollars worth of capital to invest in deals or in assets or different vehicles, or you have, $1,000. I think the most important thing you can do is invest in yourself. I think it's more important to focus on investing in yourself if you're on sort of the ladder scale of what I just described in terms of a financial position. But I think there's always an opportunity for you to invest in your own growth, whether that's through just education or learning or investing in your own health and investing in your happiness, investing in your mental health, investing in experiences, and just really expanding your horizons. I think that's the best advice that I can give to anybody, because I think the best investors, the most successful investors, are those that have and continue to invest in themselves and continue to grow. Because if I firmly believe if you're not growing, you're dying. And I definitely think that if you're not growing as an investor, you're definitely going to be falling behind. You're definitely going to be challenged in terms of your outcomes there. So that's my best piece of advice, is invest in your growth.
Yeah, I think that's great advice. How about a book recommendation? Doesn't have to be real estate related, but it certainly can be. Just something that's been impactful that you've read.
Man, there's been so many. I'm constantly reading. In fact, this is a great way to invest in yourself, like we were just talking about, is just spending time and reading from someone else who has put so much of their life experience into a book. Highly recommend just reading. So I read every single morning. I'm reading a great book right now called Good Energy by Casey Means, and it's really all about health and wellness and really about sort of ultimately how you can perform at the highest levels, but feel the best that you can possibly feel. That's a great book. But also a really fun, just curious book that I read years ago was a biography written by Walter Isaacson on Benjamin Franklin. I really, really like that book because Benjamin Franklin was a founding father, but he was also an inventor, scientist, a diplomatist, philanthropist, a kind of a superstar of his time, but such a dynamic personality and individual, and somebody who was so innovative in so many different ways and so successful as an entrepreneur. It was a really, really joyful read, and one that I kind of felt myself getting lost in. But I think there's a lot of parallels in learning from success of other people through their biographies. And while I think Benjamin Franklin had an autobiography that he wrote about himself, was kind of a different perspective. I have not actually read that. But the biography about Benjamin Franklin was one that I constantly have in my kind of top 5, one that I would recommend folks dive into.
Okay. Yeah. I've not even heard of that one. So I've always asked for the audience, but I asked for myself as well. So I'll have to check that one out. So Tyler, I really appreciate it. Thanks for being on the Wealth Flow, and I think we'll call it a show.
Absolutely. Thank you, Keith. Have a great day.
All right. You too.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.